Thank you everyone for making it on the call today. Here with good news. We have outperformed the market, which is encouraging. Albeit the outperformance is not huge in absolute terms, it is a positive number. So with that, we will dive right into those numbers and then look at our Q4 23 top pick portfolio. So as I said, we did have a gain of 1.1%, which we are encouraged. And you can see the real dichotomy or the spread divergence across market indices. You know, with this TSX small cap down by 0.8, the bigger, broader market TSX down by 2.2, and the pain incurred by the TSXV down by 10.1% on the quarter. We will just go on to the next slide if we could, where we will look at some of the numbers with a longer term perspective on the performance. And here for the year to date, you can see we are still struggling. Our top picks is down by 4.6% year to date against the TSX, ahead by 3.4%, TSX small cap by a number of negative 1.1%, and the TSXV by negative 2.2%. You know, we continue to look to our longer term outperformance, where on a 3-year basis, you can see where we are down by, or we have underperformed the TSX by 18%, underperformed the TSX small cap by 19%, but wide margin against the TSXV at 35%. So we're still working on those 3-year numbers, not pleased with that. Our 5-year numbers are definitely much stronger in absolute terms and in terms of their outperformance across each of the 3 benchmarks that we are referencing over here. You know, 5 years, 46, 68, and 109% alpha versus the TSX, the small cap, and the TSXV. So with that, we will move over to just a quick snapshot on the next slide for our Q3 top pick portfolio performance. In terms of the names that helped our performance, it was very important on the quarter to see the strong performance within the cannabis space, and Andrew's names there. You know, Verano and High Tide were both exceptional gains on the quarter at 58% and 51%. And pleased to highlight the ongoing brilliance, shall we say, of Stefan, with his diagnose ahead by 36% on the quarter. In terms of suffering pains, we turn to the commodities, where we had Ascendant down by 36% and Pan Global down by 41% in very difficult market conditions. Now we will just move on to the next slide and look at our, more importantly, our Q4 portfolio. There, in terms of new names, Mike Stevens, who is on the call, initiated and introduced on Decisive Dividend Corporation, where he is calling for a 55% return. We have Playmaker reintroduced to the portfolio, and I will talk to that further. And we have Adam with Saturn Oil and Gas as his top pick within the space. And we have Gold, which was introduced as a replacement for Ascendant, picking up a little bit of liquidity there and perhaps more, well, definitely more defensive characteristics around the name. So with that, we will now jump ahead and go into the individual names, starting off with technology. So I'm a warm-up for the bigger, better presentations. And on the next slide, we will start off with Playmaker for everyone. And what you'll find is on the 3 names that I have in the portfolio, 2 of them are ones that are benefiting from tailwinds, that they are well positioned in growth markets. And these are Playmaker and Neat. So they've got the positive mojo, they've got the positive tailwinds. The third name is more contrarian. And if we want to keep with the weather analogies, you know, they're facing a potential hailstorm. But therein lies the opportunity for that name. Now to Playmaker. It's got a market cap of 110 million, so it's not too bad on that front. It has 30 million of available funds, so it is well funded with some flexibility. We think they will exercise on that flexibility in making some tuck-in acquisitions where their track record is stellar. What the company does, they are a digital media company focused on sports content. So they are riding the waves of robust audience growth and sports betting. And the two are related. Sports betting drives audiences, audience engagement, it drives advertising, and it drives royalties on betting. So the company is really well positioned in that regard. It's very well managed, and it has very quickly assembled a portfolio of entrepreneur-driven properties where they are drawn to Playmaker for the legitimate revenue and cost synergies afforded the platform and technology that the company has. It's a company that has consistently beat consensus expectations, so you're not taking on the risk of quarterly disappointments. Reasonably valued at 8.8 times EV to EBITDA. It's really a longer-term growth at reasonable price, reasonably defensive within the small cap arena. We will move on to the second name, Neat. And Neat is a returning name to the portfolio. It is similarly holding very strong management, strong momentum, and financial flexibility, where the company has the benefit of 15 million of cash on the banks and access to an additional 15 million. It's got a reasonable size with respect to an enterprise value put at 235 million. Now, to what they do, they provide manufacturers with a platform for a digital record of quality control, otherwise known as validation. It has been the first to market with global pharma providers, right? And with global pharma, quality control is essential, and track records and historical records are key for the companies. This was previously done on a paper basis. Neat has emerged as the leader using a digital platform where the business model is SaaS-based. It's really impressive where this relatively young company has now secured contracts with 15 of the top 20 global pharma providers, where they have the classic land and expand strategy. And it's a really easy story to tell by its numbers. These high quality recurring SaaS revenues were 9 million in 2021, 17 million in 2022. And with 2023, they'll be more than our forecast of 29 million. We then have them going to 42 and 57 and 75 million. So the momentum is clearly there in the recorded numbers. The momentum is clearly there with respect to company announcements, where they've had $7 million plus contract wins for the year to date. So a quality name, defensive name, ultimately a takeout. Will never strike you as incredibly cheap, but it will probably be acquired by companies that have higher multiples. And as much as they want to get into the business, they can't or haven't. Viva, which is trading at 17.8 times EV to gross profits, said 2 years ago, we're going to do this stuff. Not yet in the field. Well, it would make sense for the industry giant Viva to buy KSI at 10 times EV to gross profit. And when you're 15 of the top 20 global pharma, you are the standard. You are the go-to. So significant value there. Now we'll just jump on to the third, which is very different. This is Quisitive. It's different in respect to it is a contrarian name. It has reasonable liquidity with an enterprise value of 174 million. It has scale revenues 188 million this year. EBITDA reported will be roughly 27 million. It has some financial flexibility, not a huge amount. Cash is 7 million. Debt available to them of just over 7 million as well. What they do, They have two established successful lines of business, plus a blue sky venture. The legacy business is IT services, 126 million in revenues. They're a close partner with Microsoft, and this is riding the move to cloud optimization. It's a growth market. The second is merchant payment, where they facilitate transactions for both e-commerce and in-store merchants. This should do just about 62 million of revenues. They bought the business paying 100 million in cash and 50 million in stock back in 2021 when their shares were $1.68, not 32 cents. Since that time, the EBITDA has tripled. So it's been a huge success for the company. The third business, I like to use the expression skunk works, but more common vernacular is blue sky venture. Here they have developed, along with Microsoft, a next-gen end-to-end payment platform. They have won the accreditation from Visa and MasterCard. Amex is expected any day, but unfortunately, it has represented an EBITDA drain of roughly 7 million this year. And they did a terrible job of managing expectations for commercial traction. They only missed by 2 years. We believe that we are very near to such traction, i.e. Q1. Now, what not to do as a small cap? Don't do a down round for accretive acquisitions. Don't mismanage expectations by 2 years. And this has led to an issue where Bankcard has doubled. And as a result, the vendors, the shareholders of Bankcard, have coupled together with the shareholders of two prior acquisitions. So they represent a block of 36% of the company, and they have announced plans to request a special meeting. Management, in contrast, owns 6%. So our view here is it's attractive on a consolidated valuation basis at 4.8 times EV to gross cash flow if you take away the losses at PayiQ. It offers exceptional value when you do it on a segment-by-segment basis, where Bankcard is the primary value driver or lever at a valuation we put at 90 cents, which we are very confident in our defense of. So for us, when the activists emerged, it should have been taken as a catalyst. There has been an apathy in the marketplace that we think is an opportunity for investors. We do not see the activists going away. We believe that they will be a catalyst to a realization on our sum of the parts valuation at $1.46. Meanwhile, when it's 32 cents and our DCF is $1.16, our sum of the parts value is $1.46, you got a huge margin there to close. So contrarian, but we like it. We think that you may get a window, or you're in a window, in part with the tax loss selling in the marketplace. So with that, I'm glad to take questions at the back, and I am very happy to hand it over to Alex, who is stepping in and stepping up for Andrew, who is away. Alex, over to you, please.
So obviously I can't fill Andrew's shoes fully, so I'm going to be very quick. We are remaining with our same top picks. Our first pick is High Tide, who delivered exceptional Q3 results for the year, beating revenue expectations for 8 consecutive quarters while recognizing 14 quarters of positive adjusted EBITDA. They also achieved a major milestone of recognizing free cash flow for the first time. This was actually 5 months ahead of management's communicated timeline. So once again, this company continues to over-deliver quarter over quarter, beating analyst expectations as well as their own expectations. Moving over to Verano. Verano has gained significant momentum following the excitement around federal reform in the US. The company provides robust financials and remains and obtains a catalyst-rich profile while trading only at 5.6x 2024 EBITDA. Key catalysts moving forward include the DEA to potentially reschedule cannabis to a Schedule 3 substance, along with various other states legalizing adult use or recreational use cannabis. And with that, I will pass it over to Stefan.
Yeah, great job. And it's hard. It's a tough act to follow. The cannabis performance. It was fantastic last quarter. So I was hoping to spike the football with my numbers this quarter, but the returns are making me look very mediocre. But I'll do my best.
Oh, you're too modest. Way too modest, Stefan.
Yeah. Anyway, so we're sticking with the same two names: Quipt Home Medical and Diagnose. So while Diagnose continued to perform well, it was up about 36%, which, irrespective, or I guess, normally would be good, except for the strong cannabis performance. And it's up 82% year to date. Quip was down 2% on the quarter, and it's basically flat on the year. So we're muddling along. But nevertheless, we still like both names since we think they have attractive valuations and upside from potential catalysts in the next few months. I'll start with Quipt. It has $11.75 target price with about 80% upside from here. For those of you who don't know the company, they're a US-based distributor of durable medical equipment for at-home care of patients with respiratory problems. So think of things like ventilators for people with COPD or CPAP instruments for people with sleep apnea. We like the business because of three major drivers. The first is strong demographic tailwinds from the aging population in the US that drives consistent organic growth in good economic times or bad in the mid to high single digits. The second is we like to say that the company's in an M&A sweet spot due to its industry structure that is highly fragmented and allows it to benefit from accretive M&A opportunities where they typically are able to pay sort of under 5 times EBITDA for acquisitions when they're tuck-in. So they have a lot of opportunities to find nice accretive acquisitions in the areas where they're located, and also move into other areas in the US where they don't operate yet. And the third is an ongoing shift to at-home care, which of course was accelerated by COVID, but is certainly lasting well beyond the pandemic, because patients prefer to have care at home when possible. But more important than what patients want, actually, the payers, so the insurance companies or government payers like Medicare, Medicaid, preferred as well, because it's much cheaper to care for a patient at home than in a hospital or in a nursing care center. And we think that's a long tailwind as well. So the key catalysts for the company going forward are proof that they will deliver on the synergies from their recent acquisitions that should allow them to meet our expectations for their EBITDA margin to climb from sort of where it is now, around 21%, to closer to 23% towards the end of this year when they report their year-end quarter. There's also potential for further accretive tuck-in acquisitions that could lead us to increase our estimates. And of course, what we like best about the company is very attractive valuation. It trades at about 5.3 times this year's EV to EBITDA, which is a nice discount to peers, which trade around 10 times. And M&A in the space, and their sector has typically been high single digit, sort of around 10 times as well. So there's opportunity for a potential takeout given how much the stock is trading at. So moving to Diagnose, where we have a $1 target price, that's about a double from here. For those of you who don't know the company, it's an artificial intelligence company with a platform to diagnose diabetic retinopathy. Diabetic retinopathy is a leading cause of blindness in adults. It occurs when unhealthy blood sugar levels in diabetics cause blood vessels to grow on the back of the eye, on the retina, which leads to vision loss. The process is asymptomatic. You don't feel it happening, and just one day sort of splotch, the blood vessel blocks your ability to see through that eye. And the only way to identify the problem is by taking a picture of the retina with a special camera that are used by eye doctors and then grading the severity. So Diagnose has developed an AI system that does this extremely well and efficiently. Their model is a highly scalable software as a service approach, where they charge $5 to $10 per diagnosis. So this is a win-win for eye clinics that charge like $30 to $50 for this type of test, since it allows them to see more patients and allows the doctors to be more efficient and focus on more valuable procedures. There are about 450 million diabetics in the world, and they're all supposed to have a retinal exam once a year. So this is really a large opportunity, a blockbuster opportunity for the company. The company has a number of eye clinics and optical retailers using and piloting their technology. Their biggest client is New Look, which is Canada's largest optical retailer with about 400 stores. They signed a deal with them in 2021, and they're in the process of installing their software across the store base. So this has been a bit of a much slower than we would have hoped, but it's happening. Like I said, more slowly than we would have liked. But once they get it installed across the store base, it should be sufficient for the company to be cash flow positive, which will we expect to happen sort of later next year. The company has also been very active on the business development front, and it's working on winning some meaningful contracts, which we hope will occur over the next couple quarters. The biggest opportunity is with EssilorLuxottica, which is by far the biggest player in the eye care space. They have over 15,000 retail locations. In 2021, they announced a memorandum of understanding to work with Essilor, and the hope is they're finally going to close a contract with them, and we're hoping that that'll occur, before year end or in the coming quarters, and that would of course be a massive game-changing catalyst for the company and the stock. The company is also bidding on RFP for the province of Quebec, where they're from, and they're in a very strong position to win that RFP. It's about a $20 million opportunity, which would be very meaningful for a company of their size. And it's possible that that could occur before year end. So with that, I'll hand it off to David Crystal, who will talk to you about his picks in the real estate sector. Take it away, David.
Thanks, Stefan. So, we're bringing back our two REIT picks from the last quarter: Flagship Communities REIT and Dream Industrial REIT. While REIT valuations have been challenged in the current interest rate environment, and neither of our picks have been immune, nor has really the broader rate-sensitive sector, the REIT space, or the utilities and some of the other interest-sensitive spaces. We continue to stick with companies that have strong underlying fundamentals, pricing power, ability to produce cash flow growth that exceeds inflation, and ability to withstand higher interest rates as their balance sheets roll over. So if we could switch over to Flagship Communities. Flagship Communities, it's a pick we've had now for over a year. You should be familiar with those on the line, but they own a trailer park portfolio in the US Midwest that really caters to blue collar workforce, generally those who cannot afford traditional apartments, cannot afford traditional home ownership. The asset class is obviously highly defensive. It has delivered decades of positive organic NOI growth through all economic conditions. This includes, over the last few decades, the dot-com bust, the global financial crisis, more recently the COVID pandemic, shrugs off economic downturns and really benefits from the upside when the economy recovers. The portfolio provides residents with the most affordable housing option in their markets. It's as much as 40 to 60% cheaper than renting an equivalent apartment or a traditional stick-built home ownership. This has only gotten worse as affordability has deteriorated. Rents recently have ramped up aggressively, and obviously with higher mortgage interest rates, home ownership affordability has deteriorated further. This relative affordability should support continued occupancy growth. The REIT's portfolio right now is running in the mid-80s occupancy. Stabilization is generally in the mid-90s. We'd expect them to see occupancy grow in the 100 to 200 basis points annually for the next several years. Turnover is structurally low and occupancy is sticky in this asset class. This is owing to the equity that tenants build up over time. They own their homes. They would have a chattel loan on the home and build up equity with each payment. There's also a significant expense related to physically removing the trailer from the property. So they actually generally sell to the next owner, the next tenant in the trailer park. So you'd have an uninterrupted stream of income from that actual site. We see significant pricing power given the relative affordability. Earlier this year, management was able to push an 8% average rent increase portfolio-wide. This is generally in keeping with inflation and in keeping with Social Security growth in Social Security payments. They have a history of mid-single-digit rent increases in lower inflation environments, which generates very solid organic growth. Further, and we've highlighted this a number of times in the past, but the REIT's balance sheet is highly defensive. The weighted average term to maturity of their debt is 11 years, and their average in-place interest rate is just 3.8% in a market that's a lot closer to 6% today. They're trading at just 60% of net asset value and 11 times our forward FFO per unit estimate, which screens very well versus the US peer group and the broader Canadian residential REIT space. So we see the REIT as highly defensive company that should provide investors with a stable and growing stream of cash flow, which trades at a very attractive valuation. Moving on to Dream Industrial REIT, our second pick. Dream owns a portfolio comprising more than 40 million square feet of industrial space across Canada, Europe, and the United States. Industrial fundamentals have tightened considerably over the last few years. They're benefiting from a number of secular tailwinds. This includes the acceleration of e-commerce, a reshoring, nearshoring, and friendshoring push in the face of geopolitical risk, which is bringing manufacturing back to Canadian, North American, Western European countries or other friendly jurisdictions, and a shift to just-in-case inventory in the face of global supply chain issues and geopolitical risk. What this has resulted in is a significant increase in industrial rents, a significant decline in vacancy, and a 40% gap has emerged between the REIT's in-place rents and current market rents. So as they lease expiring space at market rents, we expect to see organic NOI growth continue in the high single digits into the low double digits over the next several years. And that's building on a couple of years now of growth of that magnitude. Beyond the organic growth story, we expect cash flow will be bolstered by the delivery of development projects over the next several quarters. And we'd also highlight that in the first quarter of 2023, the REIT acquired a 10% interest in Summit Industrial REIT in a privatization. And that was in a joint venture structure alongside a major sovereign wealth fund. The REIT earns property management fees on the 90% of the venture that it does not own. We expect that this will be a significant source of income going forward, and greatly enhances the economic return of the 10% of the capital that they actually put up in this venture. We would expect, given that enhanced return, that a lot of the REIT's growth going forward will be in this particular joint venture or other joint venture structures. Again, that creates a new stream of income and a rapidly growing and efficient stream of income. And finally, valuation screens well. The REIT trades at a 20% NAV discount and 12 times forward cash flow. And while this is largely consistent with the Canadian industrial space, we'd highlight that the US space trades at a multiple of north of 20 times forward cash flow. So again, a platform, a company with inflation protection, growth, and organic growth that should generate a growing and predictable stream of cash flows. And with that, I'll turn it over to the mining team.
Thanks very much, David. I think I'm up first. Going with a lower risk name, I'm going to be bringing Go Gold back to the top pick portfolio, as it's one of the larger cap companies that I follow that is best positioned for potential re-rating as the company moves towards getting underground mine permits, financing, and construction of the Los Ricos South project in 2024. Notably, it's a company with $100 million US in the bank for a $140 million build cost. And that significantly reduces the kinds of financing risks that are typically associated with mining ventures. So there really is very little dilution risk with the story at this point. And as such, it's a generally low risk story that will have a number of important catalysts in early 2024 to look forward to. Those catalysts are, number one, permitting of the underground mine. Number two, delivery of the pre-feasibility report to kick off additional remaining financing, which will most likely be debt. And number three, a construction decision that would see them producing about 8.5 million ounces of silver equivalent per year at all-in sustaining costs of about $9 per ounce, actually less in the first few years, starting about late 2025. So the question with Go Gold is, if there's so little risk, what's the upside? And I think the answer lies in company comparables, and I typically point to Silvercrest Metals. Silvercrest is producing about 9.5 million ounces of silver equivalent per year at roughly $13 per ounce, all in sustaining cost. And as I pointed out, Go Gold will be producing about 8.5 million ounces of silver equivalent at an estimated cash cost of around $9 per ounce. Silvercrest has a 700 million market cap and Go Gold has a 290 million market cap. What's different about the stories? Well, in economic terms, very little, except that Silvercrest is in production, but Go Gold will be producing as much, if not more, cash flow than Silvercrest. So you're really getting the story at less than half of what Silvercrest gets for roughly the same cash flow. All you're trading here is a bit more uncertainty about the time value of money before Go Gold gets into production. Right now, I think there's also a little bit of a discount to Mexican developers around the issue of open pit mines. I think this is widely misunderstood, as there's nothing to suggest in recent legislation that the company will actually ever ban open pit mining. I believe that the current government basically talked itself into a corner, and it has been reticent for political reasons to explain itself. But I think there's a very real chance that the government will change its tune around election time, expected sometime around this time next year. And that's just to point out that the actual mine plan, it starts with an underground component for about the first 5 years, and then would transition to part open pit in about year 4 as well. But as I said, I think the risks here are very much overblown, and so I think it's mispriced risk that will generate alpha for investors. So with that, I'll hand the call over to Ryan Walker.
Thanks, Gabriel. So we're sticking with a couple of stalwarts here on the top picks portfolio. We'll start with Osino Resources. So just recall these guys are developing the Twin Hills gold project in Namibia. Nice large package here of about 4 million ounce company-wide. So really the story here has been just methodical de-risking. This is kind of a pleasantly boring story. Namibia being a great jurisdiction, we don't hear any of the issues kind of typical of other African nations. And these guys have just been ticking off the boxes as they come to a financing and then investment decision by the end of this year is the plan. So, the latest box they ticked off here was final approval of some farmland that they bought that was required for the planned mine infrastructure. So that's now just been approved by the government earlier this week. So great support for the government on this project and from locals. And that's demonstrated by the next box they have to tick here is the relocation of some historic graves on the project site. And they've already have the agreements in place with the descendants to do this. So great support there. And again, just waiting on some government waivers to do that. And and those that government approval is actually expected in the next week or two. And then moving on from that, the next big box tick is the implementation of a 5% non-carried interest for local stakeholders. So that work has been going on in the background. The company actually announced a small deal today on the Namibian Stock Exchange, and that's aimed at that group, getting them up to that and beyond the 5% threshold. And they're also in talks with a Namibian-based retirement pension fund. So again, just methodically ticking off the boxes. And the big catalyst, of course, would be the financing, mine financing and investment decision later this year. So as we wait for that, it's not just boring, typical Lassonde curve development purgatory. We've got other potential share price catalysts. A couple of months ago, we had the Eureka discovery, no pun intended there. This is a project up about 100 kilometers north of the Twin Hills flagship project that they have. First pass drilling there, 8 holes. The highlight by far, 47 meters at almost 6 grams per ton. So that's the best drill hole the company's ever delivered in its history. The project is not far from a satellite resource that they have up there, the Undundu project, about 1 million ounces. Thought initially was, well, we'll eventually truck that stuff down to Twin Hills for processing. But now with this Eureka discovery, perhaps this turns into a mining center of its own. So looking good there. And then they also have farmed out a lithium project. Saw some interesting results out of there, the first pass drilling, and that work continues. So you'll always have that as a bit of a lottery ticket as well. So like I said, the key word here is methodical. They just keep on ticking off the boxes, not sexy, but it's the work you have to do. And as you tick off these de-risking elements, once you get the final one in place, their mining license that they've been granted on a provisional basis becomes formalized. And then that opens up potential for M&A. I think, the big guys, mid-tier comes in, takes us out once all the heavy lifting is done. You've got a project with about 3 million ounces, centering a larger land package of 8,000 square kilometers, with really very little in the way of regional exploration done on it. So fits the bill perfectly for somebody to come in and have a foothold in Namibia if they're not there. So that's it on Osino. Then we'll turn to Pan Global. So unfortunately, Pan Global, as Rob kindly highlighted, had a pretty tough quarter in Q3. But we still remain very, very positive on this story. Very compelling exploration story. They have the Escacina copper, tin, silver project in the Iberian Pyrite Belt. They've been mining there literally for 2,000 years, back to the Roman era. These guys have a nice land package sandwiched right in between some producing mines and some advanced stage projects. You've got Grupo Mexico in there. You've got First Quantum. So real players, real mines, and they're literally 12 kilometers away from those mines that the companies I just mentioned. So, the main focus has been the La Romana. You can't call it technically a deposit yet because it doesn't have a resource estimate, but it's as close to that as you could get without actually putting one out. 170 holes into that so far, and they have a 99% hit rate. So far traced at over 1.3 kilometers. Recently got the surface access into the Romana West target, which they've done their first pass drilling on, 6 holes out recently. And again, this is not a new target. It's basically confirmed that La Romana continues to the west. So that work continues. We've got 6 holes drilled, the results out for those. Another 6 are pending. The company notes that all 6 of those holes contain visible copper and tin mineralization. So a pretty good sign that they're going to come back positive. And then another 13 holes to be drilled in the remainder of this project. So, and that's just 1 or /2 targets out of 12 or 14. First pass on 3 or 4 others. returned some interesting stuff. No real discovery hole, as you'd call it yet, except that maybe Kenyatta Honda that had a pretty impressive gold interval in it. So they'll follow up on those things as the year progresses, and still very positive on the story. So as far as valuation, it's basically trading at about 3.5 cents enterprise value per pound of copper equivalent in the ground. That compares with the peer group average at about 4 cents. So it's trading in and around, the kind of some companies that are basically no-go projects. And just given the emergence of La Romana deposit and their situation with infrastructure, really it should be trading at the higher end of the range of the comp. So look forward to more assays coming out the rest of the year, and hopefully getting the share price going. So that's it on Pan Global, and I'll pass it on now to Adam for his oil and gas pick.
Good morning, afternoon, everyone. So we're going to introduce Saturn Oil and Gas to the top pick portfolio. Really, this is a bit of a special story in the oil and gas space. The company has quite a bit of debt on its balance sheet, but has a plan to pay that off in rapid form over the next 6 quarters, and then those payments start to ease up. With that, the potential free cash flow generation has really kind of been discounted by the market. That said, as we think the company gets over its kind of big hump in debt payments over the next 3 quarters, it's 167 in total repayment. We do think the market will start to give a lot more value to that free cash flow potential, which currently stands at 54% on our 2024 outlook on strip pricing versus a peer average of about 15%. So with that, I really see a setup similar to what we saw in levered juniors in 2022. Those were the names that really outperformed over the first half of the year. Obviously, the conflict in Ukraine helped escalate oil prices and accelerated that debt repayment of those stories. But that said, those more levered names, as they brought down those balance sheets, definitely saw the better returns in the space. Resetting the clock to 2023, where we are today, Saturn's essentially in the same position, and given the robust oil price environment that we're in, maybe not as robust as it was in the first part of 2022, but still strong nonetheless. Essentially, kind of is in a similar setup where they're able to fund this debt payment and bring down the leverage. And with that, we think there'll be a solid re-rate in the stock. So in terms of where the stock's trading at, on an EV to debt adjusted cash flow basis, we have the stock at 1.5 times. The peer average is 2.2 times. So, almost a full point back of the group. And I do think the leverage has a lot to do with that. And then on free cash flow, given that they have a lower decline asset base, it really starts to stand out, the valuation difference in the story. They have a 54% free cash flow yield. Now, that isn't for shareholders today. That free cash flow will be going to the debt holders near term. But as we kind of get into this back half of next year, we definitely think the market's going to have to re-rate that cash flow stream higher. As I said, the peer median is 15% next year. So I think there's a lot of room for a re-rate on the story. In terms of its ability to pay down debt, there's a couple of things that have us, confident in the story. One, the company itself is a multi-asset based company producing just over 26,000 BOEs a day now. It has production in the Cardium, the Montney, Southeast Saskatchewan, and the Viking Play in West Central Saskatchewan. So you're not sitting on a single asset company where if something goes wrong with one particular field, it creates a big problem for the company. They are well diversified. The other thing that gives us confidence is, they do have flexibility in their capital spending, and with that, there's a lot of room for them to ensure that debt gets repaid. Under our current assumptions, we think they're pretty comfortable down to a $75 per barrel WTI environment under our current capital assumptions. But if they had to go to a blowdown scenario, essentially pull down capex to nothing, let the company decline and pay down that debt, these guys can go sub $50 barrel WTI and still satisfy those debt repayments. So, the setup seems pretty solid in that regards. They have the optionality on the capital side to ensure that debt gets repaid. So, we talk about the valuation, and another way I like to look at this is how much backfill in the valuation is needed to really show you the upside. And when we look over the second half of this year and to the end of 2024, the company is going to pay back so much debt, it reduces its EV by 208 a share. And currently the valuation on 2023 metrics is relatively discounted to the group. Group's at 2.8. They're at 2.2 times multiple. That said, as that debt gets repaid, that multiple starts to decrease substantially, unlike any other story in the junior E&P space. So even if the market just backfills that multiple, which essentially puts it at an inline valuation, that essentially is a 73% upside for our current share price of 286. So lots of angles to look at this story. As I said, it's a bit of a special sit in the oil and gas space. But I think these guys are in a good position to pay down this debt and get a re-rate on that multiple. And that's going to come over the coming quarters as that debt gets chipped away at. With that, I will pass it on to Mike for his top pick.
Awesome. Yeah, thanks, Adam. And so our last new entrant to the top picks portfolio, we have Decisive Dividend. As Rob mentioned at the top, we recently initiated coverage in August with a buy rating and 12-month target price of $10.75. So those who are new to the story, this is an acquisition-oriented company focused on opportunities in manufacturing pretty much exclusively. And the company's mission is to be the top choice for legacy-minded business owners who are wishing to exit, which is actually a pretty key piece to the story, and I'll touch on why that is in a second. So the company's made 11 acquisitions to date, spanning a pretty diverse range of high-quality, well-established, profitable manufacturing businesses with product offerings that include wood burning and gas stoves, various agricultural products, machining and industrial fabrication services, road maintenance, construction equipment, and even merchandising displays. As far as our investment thesis, I'll try to quickly kind of run through the top 3 reasons why we believe investors should take notice of this name. So number 1, its track record of supreme outperformance. So at the time of our initiation in August, Decisive had generated over 410% in total returns for early shareholders that were a part of its qualifying transaction in February 2015. So for context, across that same period, the TSX Total Return Index delivered just 72%. The TSX Small Cap Total Return Index generated 48%. And even south of the border, the S&P 500 gained 146%, so less than half of what Decisive provided shareholders. So we obviously view this company's track record of delivering just exceptional shareholder value as validation of the company's M&A strategy, and also just reflecting management's overall operational competency. So number 2, that M&A strategy that I just mentioned, we really believe that they have a winning, repeatable playbook. I mentioned up front Decisive's mission around being the top choice for legacy-minded business owners. And to their credit, they've really become a parent company that founders want to be acquired by. They're not looking to shed staff. They're not looking to generate cost synergies. And they have a growing track record now of 11 acquisitions that they can point to as evidence to these potential targets that, they basically do what they say they're going to do. And this has helped to enable the company to acquire these companies in non-competitive processes at just very, very cheap, attractive valuation multiples. So 3.9 times trailing EBITDA on average across these 11 transactions. Decisive, for reference, is trading right now at 8 times current EBITDA, much higher against their trailing EBITDA. So there's definitely a very considerable valuation spread there, which helps provide them a margin of safety when they are making these acquisitions. Additionally, there's just an under the radar macro tailwind that I don't think too many people think about at play here, that relates to basically that same legacy minded business owner strategy, where over 50% of Canada's baby boomer business owners are planning to exit over the next 5 years. I think it's $1.5 trillion in assets. So we expect the company to remain very acquisitive. They've made 6 acquisitions. 6 of their 11 acquisitions have come in the last under 2 years. So we don't kind of foresee them slowing down, especially with a very strong balance sheet and modest leverage right now. The third and final point I would highlight is that we expect a sustainable growing dividend. They're yielding north of 6% right now. They've hiked their dividend twice this year already, amounting to 33% growth in that dividend. We're forecasting another 2 hikes next year at 20% each. And this is due to their strong organic growth profile and low payout ratio of 58%. And they target closer to 75%. So there's a lot of room to grow that dividend. And notably and importantly, this is only on their organic assets. This is not contemplating any additional acquisitions that they're obviously going to bring in the door. So we just think there's a large runway here for ample dividend growth going forward. So I'll leave things there. I just will mention that, Decisive trades at a very reasonable valuation given its growth prospects. And while it's not really a part of our, we don't necessitate this valuation expansion or re-rating as part of our thesis. We certainly think it can happen. It will happen as more institutional investors come to the story, which is happening this year a lot. So I'll leave things there, wrap up, and I guess I'll pass things back to Rob for some Q&A.
Thanks, Mike. I'll be handling the Q&A. So to begin with, I'll ask within the cannabis sector. So Alex, what timelines are you looking at regarding some of the catalysts that you had earlier mentioned that could happen within the US?
Is shaping up to be potentially a big catalyst month for US cannabis stocks. Late November, we anticipate that the DEA will reach a rescheduling decision, which, if cannabis becomes a Schedule III substance, would omit the burdensome 280E tax treatment that cannabis companies currently receive. November 7th, so under a month away, we see legalization for recreational use of cannabis reaching the ballot in Ohio. And then finally, on November 8th, a hearing in the Florida Supreme Court will occur to decide the fate of adult use legalization going on the November 2024 ballot. So as you can see, November has the chance to be a momentous month for the US cannabis sector.
Thank you. Moving on to Stefan with healthcare. So Resmed stock, which is a CPAP manufacturer, has been hit by fears that the GLP-1 drug will reduce demand for CPAP machines over time. How could this impact Quipt, who distributes these same devices?
Yeah, that's a very interesting question. For those of you who don't know or are not following this, GLP-1 drugs are, these somewhat miraculous weight loss drugs that are incredibly popular and are likely going to be the largest class of drugs of all time. That being said, there's a couple things going on. Oh, and so the impact on sleep apnea is that sleep apnea is driven by obesity. And of course, if you lose weight, you actually your sleep apnea improves. That being said, there's a lot more to it than that. What's happened in the market, there's a number of companies that are basically anything related to obesity. They've gone down almost like a meme-like reaction to this. So I certainly do believe there's going to be an impact of these GLP-1 drugs long term. There'll be fewer obese people, but at the same time, these drugs are not being prescribed to everybody, and obesity is going to be prevalent long into the future, because although these drugs will help people lose weight, long-term cheeseburgers are still going to be delicious. So I'm pretty sure there's still going to be obese people. The other important thing to note is that insurance companies who originally have covered these drugs are seeing how widely they're being used and are pushing back dramatically on insurance coverage. So they cost about $1,000 US a month for these drugs. So if your insurance is paying for them, you'll take them and you'll lose weight. But if you have to pay that much out of pocket, it's impossible for these things to be taken widely in the population. So that's important to note as well. So you're going to see utilization decline, or people, some people who aren't able to maintain their weight loss longer term once they come off the drug. So I really don't think this is going to have a long-term impact on CPAP use. That's the short answer. But thanks for the question.
Okay, perfect. Moving on to real estate. So David, for Flagship's business is highly defensive. How would the portfolio perform in a hot economy?
Yeah, thanks, Tanvi. Well, I mean, I think we got a great idea of just that performance earlier this year with that 8% rent increase that they were able to push through. And interestingly, I mean, they are long-term operators who don't push as aggressively on the revenue line as perhaps they could. And what we've seen is the private operators in the space will come in, they'll buy a property, they'll buy a trailer park, and they'll increase the rent as much as 150% in one go. Whereas Flagship has a much longer term view and actually aims to match their rent increases a little bit closer to residents' affordability and ability to pay that rent. So the hotter the economy, in fact, the better the rent increase they can get and the easier the justification for that higher rent. So it really is that kind of all-weather business.
And then for Dream Industrial, especially given that right now recession fears are really common, how do you think that Dream's industrial portfolio would fare in a recession?
Well, they're almost the opposite business model in that historically industrial has suffered to some extent. Is certain industrial tenants have suffered in economic recessions, and that looks like either tenant bankruptcy or less space requirements. But given that industrial fundamentals nationally in North America and frankly globally are stronger than we've ever seen, and that 40% cushion between current market rent and current in-place rent is the widest we've ever seen in the industrial space. There's quite a big cushion for market rents to come down without seeing negative rent growth or negative cash flow growth. So there's no doubt that in a recession, market rents will come down, but that cushion that's evolved over the last several years should be quite defensive.
Thank you. So moving on to the mining block, we'll start off with Gabriel on Go Gold. So given that there tends to be uncertainty around getting open pit permits in Mexico, do you think that there would be any issues in financing the mine?
Thanks for the question, Tanvi. I think regardless of what happens around open pit permits in Mexico, there is actually very little risk to lenders and hence to the financing in general. And that's for a couple of reasons. First is that the underground mine will likely pay the project back even before the company ever gets to the open pit. So the payback period was estimated at, I think it was about, call it 2.5 years. And that's well before the company would ever move to doing an open pit. And the second is that the company could probably just continue to extend the mine underground through exploration. And actually, even parts of the open pit mine would be amenable to bulk underground mining. So, the worst of cases, they wouldn't even have to do an open pit mine. So from the point of view of a lender providing part of the project financing, I think there really is very little risk that they need to worry about, and certainly investors as well over that issue of open pit mining in Mexico and permits. So that's the answer.
Okay, perfect. The next question is for Ryan on Osino. What do you think the potential is as far as M&A is involved for Osino?
Yeah, look, like I said, I think, as these guys continue to de-risk the story and get that mining license formalized, I think there is some potential for some M&A activity here. The logical kind of built-in buyer seems to be B2 Gold. They're in the neighborhood. The Osino team sold them their Otjikoto mine in Namibia back in 2011, so there's an existing relationship there. But I don't hang your hat on that being the only group potentially as a buyer. I think Lundin Gold's been pretty vocal about M&A aspirations. Of course, they've got the world class Fruta del Norte gold mine down in Ecuador. Just one of the gems out there. And they're looking to move out of Ecuador, and they want a developer. So, the Lundin Group, not afraid of jurisdictions. I think they love Namibia, and the lower technical risk of a simple open pit mine might be pretty attractive too. So, we'll see. Newmont kind of had been sniffing around Osino with an a proposed exploration joint venture that didn't come to fruition, but I wouldn't rule them out. And then there's also the Navachab mine that's under private ownership, about 40 kilometers away from Twin Hills, Osino's Twin Hills. So there could be some kind of consolidation, including that as well. So I think there is some real potential, especially as they de-risk, as I said.
And for Pan Global, you had made a reference to this earlier, but could you elaborate on what is exactly behind the stock's poor performance?
Yeah, so I mean, number one, I think it's obviously a tough junior mining sector, and we've seen copper come quite hard, in response to kind of questionable economy in China. Everybody was kind of on the COVID reopening bandwagon, and that China was just kind of going to flip the big red switch and get things going again. That hasn't turned out to be the eventuality, and the real estate sector there seems to be in some pretty dire trouble, and that's a big consumer of copper. So I think Pan Global, obviously being a copper project, got caught up in that, and then as is the nature of the beast, these junior exploration / development companies are kind of hand to mouth. So they had a pretty comprehensive drill program this year and have spent a lot of money. And I think there was certainly a component of deal overhang not helping the situation. So they actually just recently launched a small non-brokered deal to try and help alleviate that and get some more funds in the door and continue drilling as they have been. So I think those are the two key factors. I don't think it's the results themselves. They've like I mentioned, they've had over 170 holes drilled into this target, and 99% hit rate. So I don't think it's in response to that.
Thanks. Moving on to the energy sector. So Saturn, Adam, how well is the company hedged for 2024?
Yeah, good question. So based on our forecast, we see the company 53% hedged on oil production for next year at a floor price of about 66 per barrel. So while this does cap some upside in cash flow in the current environment, it does really help ensure the free cash flow is there for the debt repayments. So I don't really see this story as necessarily having a ton of torque to oil because of the hedge book, but I do see it as a story that has less torque, and the torque to the oil price just given the hedge book. But in the near term, the torque really comes in the valuation and getting a re-rate and better respect for your free cash flow potential than the market's currently giving you.
Right. Okay. And since we have time, I'll take on a second question as well, which is when could Saturn start to pay out cash flow to shareholders via dividends or buybacks?
Yeah, by the end of 2024, the balance sheet starts to look to be in pretty good shape. They would have to work with their lender as they take priority on free cash flow sweeping. So I don't think this is a near-term part of the story. the company will be in a good position, I think, into 2025. The debt payments drop from 202 million in 2024 to 132 million in 2025. So we do think that, the potential starts to emerge in 2025. But as I said, they do have to work with their lender to get clearance before any free cash flow gets used for anything but development or paying back debt.
Thanks. Moving on to Decisive with Mike. So Mike, during your presentation, you touched on how diverse Decisive's various businesses are. Do you think that that could be viewed as a weakness? And also, how do you see them go about scaling into the next leg of growth as it relates to that diversity?
Yeah, thanks, Tanvi. And it's a question that we get a lot from investors, what that next leg of growth is going to be like, and whether they're going to keep this strategy of kind of further diversifying. I guess I would say a couple of things that, my perception of that diversity is that I see it as pretty impressive, like that they've been able to have the success that they've had by building out that diversification over 9+ or almost 9 years, I guess. Early on in their tenure, they were kind of exposed to certain verticals, be it the energy sector. They've got a lot of customers in the E&P field. So, they've done a great job of diversifying out their businesses, and they've done that without really realizing revenue synergies or leveraging internal capabilities and expertises. So I think it's pretty impressive what they've been able to do, and how that's now going to inform the next leg of growth is they're finally starting to leverage those internal capabilities. Like they just made their first kind of acquisition in an existing vertical. So they made an acquisition for ACR Heat. It's a hearth or firebox company in the UK, and they're able to leverage Blaze King, their North American firebox company, to kind of vet that process. After the acquisition, they integrated them in. They run that sort of vertical now. So I think that you're going to see that more and more going forward. You're going to have maybe an agricultural vertical where one of their subsidiaries is heading that up. So that's all opportunity ahead, and they're starting to put in strategies around revenue synergies finally. So yeah, I see that as a major opportunity going forward.
Great, thanks. So our last and final question comes for Rob. So Rob, on quiz, could you please speak to the lack of impact in the stocks movement, especially given the recent news?
Sure, this is very much backward lurking rationalization. I would say number one, tax loss selling, clear influence in the marketplace. Number two, apathy in the small cap market, clearly in the marketplace. Number three, investors want to see a formal letter issued and the subsequent response by the company. Number four, where the company talks up change of control provisions in large contracts, it is a little bit scary, but the reality is if those IT services assets end up with a strong buyer, Microsoft is fickle. Clients are fickle. They will go with them. So they're an ineffective barrier. I was amazed when Scotia downgraded the price target, downgraded the recommendation, given the uncertainty. I think the uncertainty is the catalyst, is the opportunity, is what is key right now. So a different perspective, I think an opportunity.
And with that, we conclude the Q&A portion of our presentation. I'm going to hand it back to Rob to conclude the presentation.
Thank you very much for your time. Please follow up with questions. We look forward to coming back with the fourth quarter and hopefully a quarter of outperformance. So in the meantime, all the best and our thanks. We are available.